Okay. So we left off on our last presentation on how to determine our purchase budget. So remember that for this company, your cost of goods sold each month will be 70% of your budgeted sales. Your desired ending inventory will be 25% of your cost of goods sold for the upcoming month. Okay? So for each month to get our desired inventory, we took 25% of the projected cost of goods sold for the upcoming month. That was done for October, for November, and for December. Okay? Now we're saying we now know the amount of inventory that we're going to need each month. Now we're looking at our cash payments. So remember that our cash payment policy was we're going to pay 60% of our purchases in the current month and then 40% in the upcoming month. So because we just started in the month of October, and let me get this off of here. Go away. Thank you. Because we just started the month of October, we do not have any sales for September, our first month of operation. So 6% of our October purchase was $87,360. But then in November, you're paying for the remaining 40% from your October purchase and 6% of your November purchases. Then in December, you're paying the remaining 40% from your November purchases and 6% of your December purchases. So the remaining 40% from December would be shown as accounts payable on our pro forma balance sheet. So this is showing again the amount of cash we expect to spend each month, October, November, December, based upon our projected purchases of inventory in the months of October, November, and December. So the cost of goods sold total would be shown on the pro forma income statement, and the ending inventory balance will be shown on our pro forma balance sheet, along with the accounts payable amount will also be shown on our pro forma balance sheet. Okay, so our pro forma income statement will show cost of goods sold for 107,680. The 35,000 in the inventory as of December 31st will be reported as a current asset on our pro forma balance sheet. The 682,384 of accounts payable will be reported as the ending accounts payable balance on our pro forma balance sheet. And again, that number will represent the 40% of the purchases that was made in the month of December. Okay. Next up, we have our selling and administrative expense budget and related schedule of cash payment. So we're saying that our sales and admin budget will be based upon 2% of our sales. So remember we said sales is important because all of our other budgets are based upon our sales projection. Okay? So our supplies expense is going to be 1% of our sales each month. The utility expense is paid in a month following the usage for electricity, gas, and water. So these are the line items that are going to be shown on our selling and administrative expense budget. Okay, so here we have our projected salary expense, our sales commission, our supplies expense, utilities, depreciation, rent expense, and your miscellaneous expense for the month of October, November, and December. This shows the expected schedule of cash payment for these expenses. So, of course, the salaries will be paid in full each month. The commission will be paid in the next month or the following month. So basically the commission you see here for October will be paid in November. The commission for November will be paid in December. Other expenses like your supplies expense are going to be paid each month. The utility expense will be paid in the following month. So the expenses for October are paid in November. The expense for November are paid in December. Of course, your rent expense must be paid each month. And then we're showing the miscellaneous expenses, where there may be notes that tell us what consists of those miscellaneous expenses. So this shows the total projected payments to be made each month for the selling and administrative expenses. Okay, so this just gives you written information what we just covered. It's showing the sales commission payable, utilities payable. So any type of payable that we have at the end of the period will be shown on the balance sheet. Accounts such as accumulated depreciation, which is a contra asset account, will also be shown on the balance sheet under your asset category. Okay. Then the projected selling and admin expenses will be shown on the pro forma income statement. This is showing the total sum of all our admin and selling expenses for the 3 months. That total is $110,172. So remember that this information from these budgets are going to be used to prepare our pro forma financial statements. So now we're going to kind of put everything all together, your sales budget, your production budget or purchase budget, your selling and admin expense budget, prepare what's known as a cash budget. What the cash budget does, alerts management to any anticipated cash charges or excess cash balances. It's going to show all of our cash inflows each month and all of our cash outflows each month based upon our estimated budgets. It will show if there will be a shortage, a deficiency of cash, and need to borrow money, or if we have excess cash, those funds can be used for the appropriate investment. So your cash budget will be divided into 3 major sections. There's a cash receipt section showing the cash coming in, a cash payment section showing the cash going out, and a financing section. So if we need to borrow money, we'll see the information shown here in our finance section. Okay? So we're going to take a look at the total cash available, which will be your beginning cash balance, along with any cash received from your customers. So, of course, the cash received from customers came from our scheduled cash receipt and our sales budget. So you can see how all these budgets are working together. Data from one budget is required to prepare the next budget. Okay? The cash pay would include cash payment for inventory purchases, our selling admin expenses, any type of interest expense, along with any investments to be made by the actual company. So the cash payment for the inventory purchases are coming from our inventory purchase budget, and then the cash payment for our selling admin expenses are coming from our selling and administrative expense budget. So once again, data from one budget is used to prepare these other budgets. Now, we plan to purchase for our store fixtures. We're going to pay cash for it in the amount of $130,000. We borrow or repay principal and interest on the last day of each month. Any money borrowed from the bank has an interest rate of 12% annually or an interest rate of 1% per month. So if we have to borrow money, this is saying that we're going to pay that money back on the last date of each month based upon a 12% annual or a 1% monthly interest rate. Now, pay attention here. We want to maintain a cash balance at the end of each month of at least $10,000, meaning that we might need to borrow money in order to maintain a minimum cash balance of $10,000. Okay, so here we have our cash budget. Let's look at our cash budget. Beginning in October, excuse me, I have to sneeze. All right, because it's our first month of operation, our beginning cash balance was zero. These are the cash receipts from our sales budget of $40,000. Total cash available will be $40,000. These are the expected disbursement or cash payments for the month of October. This is for our inventory purchases, for our selling and admin expense budget, and also we plan to buy store fixtures. So in this first month, our disbursements total $247,460. But guess what? We only have in cash $40,000. This is why you prepare a budget. So we see already in the first month, we're going to have a shortfall of roughly $207,460. Therefore, we're going to make plans to borrow in October $218,000. This allows us to take care of all of our disbursements as well as maintain our minimum cash balance of at least $10,000. So what the budget does, it allows you to plan properly. You don't want to wait until October to see that, we're going to be at a deficit. No. By us knowing now that we're going to have a deficit, we'll make plans whether to use a line of credit or to borrow money so that we can take care of all of our disbursement. Now, your ending balance for October in cash becomes your beginning cash balance. This shows our cash received in the month of November. Again, coming from your sales budget. This shows all of our cash disbursements for November. Notice now we got to pay interest on that $280,000. The interest rate is going to be 1%, will be the interest. At the end of November, we still have a shortage of $1,572. We plan to borrow $12,000 more in the month of November in order to maintain our minimum cash balance. So your November ending cash balance becomes your December beginning cash balance. This shows our cash received for the month of December. This shows our disbursement for the month of December. Now, finally, at the end of December, we'll have a surplus in cash of $23,660. So now we can pay back a portion of the amount borrowed. We pay back $13,000, and we'll still maintain our minimum cash balance of at least $10,000. We have $10,660. So what your cash budget shows you, the cash budget shows you your cash inflows, your cash outflows, whether you have a surplus or a deficit, and if we need to borrow money, how much will be borrowed each month and the amount we can actually pay back. Okay? So this is just a breakdown of the information that we just showed on the cash budget, explaining how we got those totals that was shown on our cash budget. I just kind of just went through those information. Now again, information from your cash budget will be used to prepare your pro forma financial statements. For example, your ending cash balance will be shown on your pro forma balance sheet for your cash account. Okay? So we're now ready to prepare our pro forma income statement, our pro forma balance sheet, and our pro forma statement of cash flow. You ready? Okay, then stay tuned for the conclusion of our chapter 14 video lecture. Bye.